In a world of rising costs and economic uncertainty, one question is on every investor's mind. Where can you find stability and growth? For years, inflation has been a major challenge, eroding the value of earnings and savings. But what if some companies aren't just surviving this environment, but are actually built to thrive in it? The secret often comes down to one critical factor: pricing power. Today, we're breaking down an institutional equity research report that identifies 6 powerful companies positioned to outperform in the inflationary period from 2025 to 2028. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. So what exactly is pricing power? It's a company's ability to raise its prices to offset rising costs without losing its customers. This is critical for outperformance during inflation. The report we're examining lays out a clear investment thesis built on 3 core ideas. First, it focuses on stocks that are leaders in their respective industries. These companies have high brand equity and a global reach that allows for consistent price hikes. Second, they have a proven track record of passing on rising input costs to customers, which protects their gross margins even in severe economic cycles. And third, they rank at or near the top of their peer groups on key valuation, growth, and risk measures, making them attractive for institutional portfolios. Let's start with the company ranked number 1 in this analysis, ASML. For those unfamiliar, ASML is a technology monopolist in the semiconductor industry. Their projected revenue growth for 2025 is a staggering 20%, with a net margin expected to hit over 30%. Its pricing power comes from its near monopoly on extreme ultraviolet, or EUV, lithography machines, which are essential for making the world's most advanced chips. The report notes that ASML has been able to increase the price of these machines by about 10% annually, demonstrating a powerful ability to pass on costs. Its valuation, with a forward PE of nearly 38, is well above the industry median, but the report argues this is warranted by its unique technological dominance. Coming in at number 2 is a name everyone knows: Visa. As a scaled payment network, Visa benefits from what the report calls inelastic demand. Its financial metrics are exceptional, with a forecasted net margin of over 52% and a return on equity of around 46%. Visa's strength lies in its ability to pass through costs almost frictionlessly via its interchange and assessment fee structures. With revenue projected to grow over 11% and high cash flow growth, its PE ratio of 33 is considered justified, especially given the ongoing global expansion of digital payments. Ranked 3rd is the global beverage giant Coca-Cola. Its power comes from pure brand pricing and innovation. The company has demonstrated a remarkable ability to increase prices without a major drop in volume, a testament to its customer loyalty. With a 2025 estimated net margin of 27%, Coca-Cola is a stable inflation fighter and a consistent free cash flow generator. Its valuation, with a PE of 23.5, sits just below the sector median, which the report suggests is attractive given its top-tier pricing leverage. The 4th company on the list is Thermo Fisher Scientific, a critical player in the life sciences and laboratory equipment space. Its key advantage is its sticky customer base. Once a lab is built around Thermo Fisher equipment, the cost of switching is incredibly high. This allows for steady price increases. The report highlights a powerful piece of strategic pricing. Every 1% price hike drives a 6% increase in EBIT growth. With a steady net margin around 16% and a balanced mix of recurring revenue from consumables, Thermo Fisher is presented as a defensive platform with consistent cash flow. Moving to number 5, we have Hershey, the branded confect company. Hershey's strength is its resilient shopper loyalty. The company has executed repeated price hikes since 2021 with only minimal volume loss. It's forecasting a 2025 net margin of 13.5%. However, the report is clear about the risks. Margin compression due to soaring cocoa prices is a significant concern. The analysis notes that for every 10% rise in cocoa prices, Hershey's gross margin could compress by up to 60 basis points if price actions lag. This makes its margin outlook more volatile than the others. Finally, at number 6 is Chipotle Mexican Grill. Chipotle is a story of explosive growth, with revenue projected to grow 13% year over year. It has shown the highest price and mix growth in its sector, with menu prices up 20% since 2020, outpacing both peers and inflation. But this aggressive pricing comes with risk. The report flags rising elasticity risk, meaning that if costs continue to surge, further price hikes could finally start to drive customers away. Its high valuation, with a PE of 47, reflects this high-growth, high-risk profile. Now, let's look at the bigger picture by comparing these companies. A quick glance at the financial metrics shows clear leaders in different areas. ASML, Visa, and Coca-Cola lead on margin and return metrics. Visa's gross margin of 81% and net margin of 52% are in a class of their own. In contrast, Thermo Fisher and Hershey stand out for their recurring cash flow and supply chain control. Chipotle excels on pure top-line growth, but with the highest valuation and volatility. The report also provides a valuable comparison against industry medians. For example, the median PE ratio for the industries covered is 24. Chipotle at 47 and ASML at 37.7 trade at a significant premium, while Coca-Cola and Thermo Fisher are valued more closely to the median. This context is crucial for understanding what you're paying for. In some cases, it's monopolistic technology, and in others, it's high-octane growth. Of course, no investment thesis is complete without a clear-eyed view of the risks. The report outlines several key challenges. The most immediate is commodity shock exposure. Hershey is directly exposed to cocoa prices, while Chipotle is vulnerable to protein and dairy costs. The probability of this risk is high, with a moderate to severe impact. Next is regulatory risk. The payment sector, including Visa, continually faces scrutiny over fee caps and taxes. Similarly, beverage and food companies like Coca-Cola and Hershey could face new food taxes. The third major risk is buyer power and consumer elasticity. Chipotle and Coca-Cola in particular are testing the limits of how much they can raise prices before consumers look for cheaper alternatives, especially in an extreme inflationary environment. Finally, there are competition and macroeconomic factors. ASML faces potential export limits, and all of these international companies are exposed to foreign exchange fluctuations. The analysis provides forward-looking scenarios, suggesting a 5% regulatory fee cap could cut 4 to 6% from Visa and ASML's earnings base, showing how sensitive these giants can be to policy shifts. So what is the key takeaway from this deep dive? In an inflationary period expected to last from 2025 to 2028, companies with durable competitive advantages, what some call a moat, are best positioned to protect their profitability. This report identifies 6 such companies, but they are not all created equal. ASML and Visa stand out for their near monopolistic business models and extraordinary margins. Coca-Cola and Thermo Fisher offer more stable, defensive qualities, relying on brand loyalty and high switching costs. And Hershey and Chipotle present a higher risk, high reward profile, where strong brand power is tested by volatile commodity costs and consumer price sensitivity. Ultimately, the analysis concludes that while pricing power is a powerful shield against inflation, understanding the specific risks each company faces is absolutely critical. We hope this breakdown provided valuable insights into navigating today's complex market. If you found this analysis helpful, please hit the like button, share it with someone who might be interested, and subscribe to our channel for more deep dives into the forces shaping our economy. Thanks for watching.